Welcome to another episode of Yahoo Finance Uncut. I am your host, Jared Blikre, and I am here with Peter Borish. He is the president of Computer Trading Group, Computer Trading Corp, and also a partner at Torsion Tech. That is a natural gas hedge fund and also a veteran trader legend in the industry. Want to waste no more time here and bring him in. Peter, very glad you could be with us here. And we're going to get a lot into your background and some of the bigger market moves and your history and what you're seeing in the derivatives market. Just want to kind of get your market overview of where we are right now. People are going to be watching this over the next couple of weeks. We're trying to keep this a little bit evergreen, but people want to know what the Fed is going to do next, especially in light of a recent Wall Street Journal article that says the next move in late September is going to be 75 basis points to the upside instead of 50. And risk markets have been selling off a little bit recently.
Well, first of all, thank you so much for having me. It's really a tremendous opportunity to be involved in a discussion that's a little bit more in-depth and detailed than the normal, few minutes discussing markets. So the quick and dirty from my perspective, and remember, I'm sort of a global macro trader, but I always define that the right to change my mind when it comes to a position begins as soon as I put my tongue back in my mouth. So where I am today is that, first of all, whether the Fed raises 50 or 75 basis points, to me, is not that relevant. What is relevant is how markets react to that. And why many are worried about inflation, and I think we can get into this, my concern is that the U.S. with this monetary policy is embarking on a tremendously fraught path of importing deflation, and we're seeing that with regard to the record move in the dollar. So usually a really, really strong home currency is not so great for domestic equity markets. So we're on a teetering. If we hold these levels, 38.80, about the lows from last night in the futures markets, we might have a bounce. But I think between now, certainly to September expiration, which is only 8 days away, and further into October expiration, I think the markets will be under pressure, which is interesting because around October expiration is when the next cycle of tech earnings come out. We bottomed in July, on July expiration, as tech earnings started to come out. That's going to really tell us some momentum for the rest of the year. Are they better than expected, or is the rising dollar, the deflationary pressures, rising interest rates hurting those earnings? And in which case we could be a little bit more like just 18, where we're down deep into the fourth quarter.
Well, that's really interesting. I noticed you used the D word there, which is deflation. That was early on in your response. And of course, the Fed is fighting inflation right now. And we see this huge surging dollar. I'm glad you brought that up, because I think that's one of the bigger drivers, at least one of some of the evidence that we have a lot going on under the hood in the markets right now. Also a crashing yen, another safe haven currency. And you're talking about earnings, not even the next CPI print. So I'm wondering how you put this all together. Seems like deflation might be on a longer term view. And then just how does this fit in with your more near term view when you're looking at various earnings and what's going to happen over the next few weeks to maybe month and a half here?
So I've been sort of taking the read from the dollar and the dollar euro in particular. And that has been somewhat leading almost all the markets. And if we look at all risk assets, they are behaving as we're in a non-inflationary environment, whether that's Bitcoin, crude oil. Let's look at natural gas over the last couple of weeks or over the last 5 months, how it's been, from a trading perspective, a round trip to nowhere. A lot of volatility, but you're exactly where you were. You went up a lot, you went down a lot, enormously frustrating for those that sort of are trying to be, trend followers in the marketplace. All of the markets and crude, of course, and let's really step back from the most important perspective, I think, is that we talked about surging energy prices, but the price of crude did not even take out the high from '08. The closest analogy I can think to that for those who are really been in the markets for a long time is silver. When gold made its new all-time high a few years ago, silver got close, like crude got now, and did not even take out its 1980 high. That is telling you a major, major divergence. So gasoline prices made new highs, crude didn't, and we've had an enormous correction. Gasoline prices are closer to where we started the year than where we were in the summer highs. So all these things, I'd listen to the markets. That's why I said, is it 50 points? Is it 75 basis points? To me, that's not relevant. I have views, but what matters most importantly when it comes to markets, if you're expressing those views, is to have risk management associated with that. So right now, the market and the equity markets are sort of in this little bit of a no person's land in terms of the trading range. Stay aside. But you broke down this morning in crude oil. Natural gas has gone back to its lows from 6 weeks ago after making new contract highs. Again, you've had a lot of divergences along the natural gas spectrum. And these type of markets that have a lot of contract months, so the further out the producers are there, they're more fundamentally oriented. I look for those for signals. I'm always looking for signals, and I'm always assuming, most importantly, that I'm wrong. In this business, being right is a gift. Being wrong is what happens most of the time. It's literally like being a baseball player. If you have a year where you hit 250, it's hard to stay in the majors. But if you have hit 330, which doesn't seem like a big difference, you're going to be an all-star for a long time.
Well, Peter, this is great, because what I like about these longer form interviews is we can get into topics like risk management and what that means for traders. And I'm glad I have your overview for where we are now, which is, as you kind of admitted, a no person's land, or we don't know exactly what's going to happen next. We're waiting for another catalyst. So let's talk about risk management right here. And you gave that baseball analogy, and I happen to have a background in commodities as well. So I know the CTAs, that's commodity trading advisors, tend to be momentum traders for the most part. Maybe a lot of them are looking for 1 in 3 trades to actually work out, but it's the risk management that really makes the winners and separates the winners from the losers, not the trades, but the game in the game itself. And I'm just wondering if you could impart some of your wisdom trading over the years and what you've learned trying to trade these markets. What has kept you honest?
Well, I don't know if I have that much wisdom, but I've been honored to have been associated with some of the best traders in the world, coming up and having worked with Paul Tudor Jones at Tudor and that risk management, having helped George Soros and providing all that data in the early days for his Alchemy of Finance. And I recommend everybody read that's a tough book, but Soros on Soros. And in there, he says 2 things that always resonates with me when it comes to risk management. 1, yes, there are trend followers and there's momentum type trading. And a lot of people think, oh, that's so silly and that's stupid, but it's successful. And he says, most of the time you want to be with the trend, but you want to be mindful of inflection points. And those inflection points are a number of things, right? Waning momentum. I say to people, trading is a second derivative business. It's not a first derivative, right? It's the rate of speeds. When things go up very, very quickly and then they slow down, that's when you want to get defensive. And the other thing that George talks about when it comes to risk management is that markets are never stable, right? That's sort of the theory of reflexivity that he developed. And so when you're at extremes in a trend, you're going to see a pickup in volatility. And most big moves happen from oversold conditions or overbought conditions. And that is common in equity markets and it's common in commodity markets. But I will just add personally that the beanstalk never grows to the sky. The goal of our business, traders and everything else, is we're here to make money. We're not here to be right. So that's why I go back to my first line. I can change my mind immediately. I have to take my ego, put it aside, because being wrong is just part of the business. As Derek Jeter says, fans worry about the last game. The players worry about the next game. You take your loss, you try to minimize that loss through sophisticated risk management, and then move on to the next trade.
Well, I know you did say that you wanted to talk a little bit of baseball here, and it looks like you're doing that, and there'll be plenty of opportunities for that. I like what you said about risk management, and then getting back to, you were talking about George Soros as a mentor. Paul Tudor Jones, a name you also mentioned, and you and I were talking about this offline. There was a documentary that public television did called Trader on Paul Tudor Jones, and you were featured in it as well. And this is in 1987, prior to the lead up to that great crash in October of that year. You were tracking the market and finding an analog, a historical analog to a previous market epic, and you were expecting a big downturn. Nothing unfolds 100% the way it does in history, but my goodness, I mean, that you had a documentary filming, you had the cameras there, and then you got this big market decline pretty much on cue. I'm just wondering, what was it like to go through that event in real time?
Well, first of all, for me, as the head of research and leading that effort, it was extraordinarily humbling. But to really put it in perspective, you have to give Paul the credit for investing at that time in data and technology that cost a lot of money that people were not yet ready to invest in. That put us as a firm far ahead of the curve. One of the greatest honors of my life was after the crash of '87, they had the Brady Commission. And I was seconded to the Brady Commission, and to work there, I was the youngest person on the commission. And if you read the report, all the data about what happened intraday around that came from us because we had it. The big firms did not yet have it. In fact, it was housed out of the Federal Reserve Bank, the Commission of New York. And when it came time to going through the data, they didn't even have the ability to display it there. I brought them all over to our office. We even had invested in those big, large monitors. But we have to be careful when you go back to that. Everybody sees the outcome and they look at success. But the reality is, when we were building this model, there were points along the way and in the documentary where we thought certain things were going to happen. Maybe the rally was going to begin earlier. And if you watch it closer, we got really hammered on a couple of days there. We had to take our licks like all traders do and come back. Originally, when I had forecast a model, I thought this was going to happen and go into sort of January of '88. Many major market tops, historically, it happened in the month of January. But then when all the data lined up, and it's sort of interesting because we're in September, and when it lined up sort of post-September expiration then and into early October and then failed, then we got really, really confident. And that's where Paul's skills as a trader really came into play. And I always say that if I was a genius, which I'm not, but I got the exact low right and the exact high right in the market, he would still make more money than I would, because markets don't go straight up and down, and he's a far better trader.
Well, I think that underscores a decent point there, which is I've always thought that you could give traders 20 different traders entries and exits and say, here's where you want to get in, here's where you want to get out in terms of profit losses, then you have a stop loss. And then if you roll the clock a little bit forward, you probably have 20 completely different results, which just speaks as to the execution factor for the trader. So we have a gamut of traders in terms of experience that watch these things. Of course, a lot of new traders that came in with the meme craze, but we also have a lot of established people who are managing their 401k accounts. And I'm just wondering, what do you say to people as they're trying to navigate this market environment? Because it's really quite a bit different than anything most people have experienced in their entire lifetime, because we're dealing with some numbers here in terms of inflation we haven't seen in 40 plus years.
Well, that's a great but loaded question. I try to say, if you're going to trade, trade. If you're going to invest, invest. But don't start trading and then having a losing position and then say you're going to be an investor because you don't want to take your losses. It's two different things. For me, I have a different time frame where my young adult children who are in the early stages of the career, they have a far longer time frame. And in which case, a market pullback, decline, bear market, however, may be a tremendous opportunity. If you're older and 3 years from retirement, which fortunately I'm not, then your risk preferences have to change. So you've got to take all those different variables into account when you're looking at it. But one of the worst things anyone can have is quick and easy success, because what that does is make you lose your discipline. If you lose your discipline in the marketplace, you're in huge trouble, because that's when your losses magnified. You have to participate. If you're going to trade, you have to trade on your terms, not the market's terms. And that gets very hard, because mentally, and then we could go back to the CTAs if you want, why they're disciplined and systematic, or other great firms, because mentally the market is always making you try to lose your discipline. Well, I'm not going to get out today because it's Friday, it's near the close, there's a lack of liquidity. I'm not going to do the trade today because the CPI is coming out. I'm not going to do the trade because it's options expiration in 2 days. I'm not going to do the trade today because I didn't sleep well last night, so I'm not in a good mood. Whatever excuse you want to come up with, you can self-justify making little losses, much larger losses, but that becomes much more difficult to get back and make money.
So to summarize, honesty is the best policy here, especially when it comes to yourself. At least that's what I'm hearing.
Absolutely. We're really, really good at not intentionally, but unintentionally lying to ourselves to make excuses for our losses.
And I just wanted we had a chance to talk offline, and we were talking about some of the market stats I get bandied about. Full disclosure, I'm in the news business, and I actually generate some of these stats for our news organization. But I think they all have to come in context. So we'll say, this is the fastest bear market, or the pandemic bear market was the fastest in history. Okay. And then we have others, midterm elections, they exhibit this seasonality from September into November, going back to 1980 or to the post-World War II era. But all of these tend to be limited snapshots in time. And one of the things I notice is that, well, statistics, they can prove just about anything if you change the variables, if you change the scope of them. I'm just wondering, how much do you place weight in seasonals or these kinds of statistical studies that a lot of people look at, for that matter, that I look at sometimes?
I think our job is to look at everything and weight it. I always used to say, when we were actively trading and I had my CTA and we were trading soybeans, if someone said to me, it's a full moon, you should be selling soybeans, I'd be like, okay, let's go back in history and get all the full moons, overlay that against all the history of the prices of soybeans. Is it true, or is it just a wives' tale? A lot of research is disproving wives' tales. And so a lot of that has to do with the speed of a bear market, the fact that we had a decline now, and then we went back up 50% off the low. And now, because we've gone back down, there's a new set of excuses coming out. well, that was the S&P, but in the bear market in the NASDAQ went up more than 50%, then made new lows. Now the fact that the S&P has a higher weight of tech stocks than it had previously, that might not mean so much. So you're reacting to the news. The one thing for traders, even for investors, most of the time, buyers are higher, sellers are lower. That's not really what you want to be. Everybody loved Bitcoin at 50,000. They're not loving it so much at 20. Okay, why? Now, if the thesis broke, whether that's an equity or commodity or however you want to define what Bitcoin is, that's one thing. But if the thesis hasn't broken, now maybe you have an opportunity to purchase it at a better price. Technically, we get down to 17 to 15, and that was the old high in 17. Maybe that's a price to lean against. And you go, okay, that makes sense. But that means you need risk management. If that's a price to lean against, it shouldn't go much below that. So that's the hard part. Working out a game plan, unemotional and in advance, and then executing it. I have people in the business that I know that only look at markets and determine their discretionary orders on the weekend. So the market's not open and the wiggles can't emotionally affect them, which it affects all of us. There's no question about it. Just go back to last Friday and the unemployment number. Wow, right? Big up day. Everybody thinks it's okay. That's Goldilocks. The number's good, but not so good that the Fed's going to raise 75 basis points and then, oops, we collapse. So I have one line that I've always well known for. Price makes news, not the other way around. So we sold off. Fed's raising 75 basis points. We rally today. Maybe it's going to be, not so much. Maybe it's only going to be 50 basis points because crude sold off. We're really good as a species, and for me as a trader, really great at talking my position.
Yeah, that's what our live shows are all about. People talking their positions and other people having other positions and seeing where the dust falls. I do like that saying. I have one I say myself, which is price precedes narrative, kind of a play on Oscar Wilde's old maxim that literature anticipates life. That's where I was going with this. But it is something that if you watch what happens with the S&P 500 or crude oil during the day, you can see it go above the unchanged. You can see it go below the unchanged, and the media accounts, they kind of vary with that. And it's not necessarily like we didn't have this news before. So I guess my point is, I think it's necessary as a trader or even an investor to tune out some of the news, if not a lot of the news sometimes. How do you select what you need to listen to? And I know you're an institutional trader, you have a lot more resources than people do, than the average investor might, but what can people do to help filter out the noise and concentrate on what actually matters?
Wow, that is so insightful. I'm not even sure I can answer it because it's almost the essence of everything. It has to be a weight of the evidence. And you as a participant in the marketplace, one is a function of your time frame as your trader. If you're a longer term trader, then what's going on intraday doesn't matter. And if you are reacting to that, then you're hurting your own strategy. If you are a shorter term trader, then that whole sort of narrative of what the Fed's doing in the meeting in 3 weeks is completely irrelevant, because what matters is the action today. I try to take a weight of the evidence. I try to absorb as much information as I can and then try to weight that. But on top of everything, it all comes down to the risk management aspect to it. So sometimes the technicals are telling you one story. Other times the fundamentals are telling a different story. It's in that environment that you really don't want to trade that big. Because you may think that, okay, the technicals are breaking down, but if the fundamentals are still fairly there, that's supporting the market. It's when there's an intersection between those two, that's when you can get more aggressive and take a larger position. And when I say technicals, that means if you're trading some sort of consistency where you're risking X amount of basis points per trade, most of the time we risk too much on an individual trade, and we can't have losing streaks. You have to be able to withstand losing streaks. You know, one of the things when I talk to younger traders is that records are made to be broken. But if you keep buying options, call options on some record to be broken, you're going to run out of money before it's broken. If you keep selling options to earn that premium, thinking that the record's not going to be broken, when it gets broken, you go bankrupt. So it's really difficult. So just to say something's never going to happen or it's likely to happen isn't sufficient. You have to have a collared risk management approach around that.
Yeah, I'm really glad you got into that. Two sayings that we like to talk about around here: know your time frame, know your risk tolerance, and your risk tolerance levels as well. Just thinking in general, we were talking about some of the big moves in commodities, but you also mentioned crypto, and also relating that to the strengthening U.S. dollar. Crypto is a currency, of course, and if you have the dollar increasing, that's the denominator here. That is going to reduce the value of the crypto. And then we saw Bitcoin trading with an 18,000 handle today. And as you pointed out earlier, that is testing those 2017 November and December highs, depending on your exchange, $17,000 to $20,000. What are you looking at in terms of the price movement in Bitcoin and Ethereum? Now we have this big split with Ethereum. Anything that is catching your eye as an investor?
Well, Ethereum has been outperforming recently, and that might have to do with the split. So I would be very cautious around there. You know, the old buy the rumor, sell the fact. So that's something in the back of my mind here when it comes to that. Bitcoin has been trading synonymously with risk on, risk off. It's not diversifying. So when you look at your portfolio, if you want to have a diversified portfolio, don't have 10 different bets that are all the same way, because you just have the same thing 10 different times. That's not good risk management. So here, I would say, if you think that the equity market is bottoming, the dollar is topping, if the commodity sell-off is complete, right? So all the risk-off aspects have taken place, then that's probably a good time to enter into Bitcoin, because its multiplier effect on the upside is probably larger. But if that's not the case, then it's going to continue to go lower. Now, I will look for those divergences for a possible inflection point when its behavior starts to change relative to, as I said, the risk on, risk off trade. Right now, it's trading similar to that. So while we're talking here, just to give an idea, if the equity market was sold off last night and Bitcoin sold off with it, now the equity market has turned around, or at least until we put this on, and my guess would be that Bitcoin has turned around with it, and maybe it's back up to 19,000 or 19,000 and change. Okay, all that tells me is it's not really a market that I want to be in right now until its behavioral characteristics change. I would rather be in a more liquid, more transparent market than Bitcoin.
Interesting that it's emerged, I would say Bitcoin specifically, as a high beta play on the NASDAQ 100. And well, you can always increase the gearing or leverage on your NASDAQ 100 plays if you're trading the futures. But it brings up an interesting point, I think, that we have this nascent asset class that is cryptocurrencies, but really not providing much diversification, as you pointed out. I think the vast majority of statistical studies, especially over the last year or two, show it's really just levered not only towards tech, but the Federal Reserve. Or is it risk on with respect to the Fed, or are they not? But getting back to diversity and the importance of having diversified trades, as we talked about offline, all correlations tend to go to 1 or -1 in times of crisis. And then we have this 60-40 model that is clearly broken, even though it worked over the last 40 years. Where can investors turn for true diversification now, if at all?
Again, a really interesting point. I want to step back for a moment as I try to address that question. So the technology associated with Bitcoin and blockchain is outstanding, and people know that. But we also knew in the 80s that computers were going to change the world. Literally, Paul and I were in on a weekend taking computers apart, taking out floppy drives, putting in hard drives, right? More memory, more technology. But it took a long time. We knew the internet was going to change the world. Everybody was really high on the fact of the legalization and the medical use of cannabis in the 2000s. Each time you had low barriers to entry, tremendous amount of capital moving in, a lot of innovation, but that wasn't the time to invest. The time to invest was to wait until there was a washout. And by the way, you can go back to the 20s for automobiles and radios. It's the same thing. And now it's the same, in my mind, with blockchain, Bitcoin, et cetera. Low barriers to entry, people coming in, lots of innovation. You want to wait. The biggest mistake of my life probably was you want to be the buyer from when it's going from 5 to 10, not when it's going from 10 to 5. So if you think of Apple, if you think of Amazon, they were survivors and they all went down to 5 and they came back. Most of them that went to 5 went to 0. So in this case, you want to wait and purchase the survivors and not be the hero saying, yes, I know this is great. So going back to your 60-40 in history, I think it's super important, and I try to lay this out, and I've talked about this a lot. I have the opportunity to global macro consult with CIBC, as you know, the great Canadian bank, and after coming out of the pandemic, we talked about the fact that we had a 38-year bear market from 1944 to 1982. In bonds. Then we had a 38-year bull market from 1982 to 2020. So if we're in the early stages of rising rates, I don't know what the level they're going to get to, but I think we could say that we made generational lows in 2020. The 60-40 model is following that. Rates have gone up. We haven't even normalized the rates. If you believe the Fed curve, which I'm a markets person, I'm not a Fed forecaster person, maybe because that's where I started my career. And I learned early on, if you're going to forecast often. So you can take into account new data. We all want this magical answer of, okay, here's the forecast. This is what's going to happen. That's not what's going to happen. It's a path. And I made this mistake early on in my career. You take all this history, it's one path. You have all that data, you know what happened. But now you're going for an uncertain future. Every day you move further away from today, that cone of uncertainty gets wider, which is why you need to trade smaller and you have to have stops, because the path that you think is going to happen is very, very low probability that it's going to happen along that particular path. So yes, I would be super concerned for a younger person now saying, hey, 60-40. No, but yields right now, you can get 3.5 on 2 years. And if you're my mother's age, knock on wood, who's 90, I'm like, should I have her in, energy stocks? Or should I put her in 2 years earning 3.5%? Now, the probability, I'm hoping she lives to 105, but I would rather roll those overs and take the risk of the volatility in equity markets at that age. So it depends where you are on your spectrum. But if you're younger and you want to take risk, being 60-40 is not likely to reduce your risk. It may add your risk, and you're better off being in those assets that have a real chance to appreciate over time. Because even if we go to 5.5 or 6%, which, by the way, historically isn't that high, but we as human beings, we always anchor right to the most recent price. And that's where a lot of people make mistakes when it comes to stocks. Oh, the price was here, it's come down, I'm going to hold on to it. Maybe it won't go all the way back, but it'll come back. Or I'm buying and it was here and I think it's going to come. You can't anchor to a price. You have to deal with today's price. That's the reality.
A recency bias. And another thing I like to point out, a stock is down 90%, as many of these early pandemic darlings are. Well, it's going to take a 900% rally to get back up to break even. I think what you're talking about relates to a phrase of yours that I've heard you speak many times. Generals are fighting the last battle, and there's a lot of recency bias built in. You were talking about that 40-year downtrend in yields. So basically, if we don't have a chart here, I can draw it for you. It's like this, the 10-year all the way down from something like 18%, maybe as high as 20, all the way down to near zero at its nadir. And we've seen it kind of pick up here. It's a bottoming process in a 40-year trend. Well, that can last a bit of time, but what do you think is going to emerge on the other side here? You're talking about your portfolio with respect to your mother. Hope she does make it to 105, but what are you looking at over the next few years?
So just one important point there. In that downtrend of yields, and I did this study because I don't have a very interesting life, so I think
I do these things too.
50% of the months bond futures prices were down. Of course, they were down less than they were up, right? Remember, futures prices are inverse to yields. So it's not a straight line. So a lot of people, oh, this is it. And if you go back and you look at the literature, and every time there was an up move in yields, and you go into this business and particularly think about, maybe it's just before your time, the transition from 1993 to 1994 in the markets, which was a tough year, and rates went up, and everybody said, "Oh, that's the bottom's in." Of course, that wasn't the case. So where you are over your time frame is the great thing, and I hate to say this as a trader, but I say this to my kids who are, late 20s, early 30s, is if you invest in a lower cost index type of fund and diversify across those, the indices actually reweight them for you over time, right? The S&Ps are replacing things, the NASDAQ. That's a real benefit. Whereas if you just think that you're smarter and you're going to pick the one stock, that's tough. So here is my insignificant piece of information for the day for your viewers. If you take the top 10 market cap stocks from 78, from the end of 88, from the end of 98, from the end of 08, I picked those because the highest, but it really should be the 9, right? So, and then you look 10 years later, on average, all those stocks that you thought were the greatest because they were in the top 10 of market cap, only 2 to 3 of them are in the top 10 of market cap stocks a decade later. So if we look at Apple has the highest weight of the S&P relative to the second stock, I think, until, here's the next piece of insignificant, IBM in 1985. IBM was the highest weighted cap stock. It had over 6%. The number 2 stock, I think, was ExxonMobil. Those were not the time to be buying IBM. So I have no clue whether this is a great time or not a great time to be buying Apple, but probabilities say just like Microsoft for a decade. It can be a great company, but it doesn't mean it's necessarily a great stock to be invested in. So I would recommend for those on the earlier side, saving side of their careers, if you're not a professional trader. Now, if you want to take some small part of your assets and you want to do that and learn and potentially gain from that, but have a diversified, broader based portfolio, the part number two of all this is you have to be willing to rebalance. The hardest thing for me, and I think for many others, is to be selling your winners and rebalancing your portfolio. So if you started with a XYZ percentage, and then all of a sudden you were super great in equities in 21, and now it's 1.4 relative to what its weight should be, you have to have that discipline to take it down and do other things. The best example, of course, of that is energy stocks, right? And at one point, it was more than 10, 12% of the weight of the S&Ps. By the time we got to the bottom in energy prices, it was 4 or 5%. Then energy rallied and everybody said, well, we didn't benefit. Yeah, because you didn't reweight, you didn't take some money off the table and rebalance your portfolio. Very hard to do. All the things that I'm talking about here, super easy intellectually, emotionally, and logistically doing it. Again, go back to, you can always talk yourself out of it.
Easy to talk yourself into or out of a lot of things in trading. Peter, we got, I want to go a little bit personal, and I'll give you kind of the floor here, just in terms of your background. And we talked about your history with some other legendary traders. What have you gained through your experience trading, the people you've met? Anything stand out to you? And we got some time here, so just kind of giving you the floor.
Well, I think to be successful in this business, of course, if you survive, you win. But when I talk to most people, one of the best things for me, which is so humbling, is I've lost money in every imaginable way. And every time you think you have learned or you know what's going on, it becomes more humbling and you lose in a different way. And everything that I've said here, whether it's talking yourself out of a position, making excuses, I've done myself. And so I always give this trading presentation, and my last slide is, if you survive, you win. You can only survive by learning from your mistakes and trying not to repeat those particular mistakes. You are going to have new mistakes. So the issue of going back and looking at Reddit and the meme stocks, that's a really great narrative, but that happens sort of all the time, right? Stocks on the way to zero, if they're going to go bankrupt, often have multiple 100% rallies on the way down. Lack of liquidity, buying. I think what's different today in a lot of markets too is that you have to look more closely in terms of the options markets. I think that that's an area that I've really focused attention on, because that's the only trading strategy that I'm aware of that actually pushes the market in the direction of the trend. And I think it's something that people should look at more so from a regulatory point of view, from a position limit point of view. Why is that? Well, if you're short a stock and it goes down, you're a natural buyer. If you're short futures and it goes down, you're a natural buyer. The problem is, if you've sold puts and the stock goes down, you have to sell in the direction of the market to cover them, or you buy them back and then the market maker on the other side is selling. So you're seeing, when I go in the first line, when I talk about September expiration, it's there because there's a lot more participation. As you get closer to that expiration, not to start talking about all the Greeks, but gamma becomes a larger issue, right? That's the rate of speed at which the market can go from out of the money to in the money, and the leverage on that is really great. So if I were really trading and I thought, okay, we're at 3,900 and I think we're going to be at 3,600 in 10 days from now, then the best way to do that is not selling futures, right? The best way to do that is to buy cheap, deep out of the money puts because they don't have any time value left in them. And their gamma, if you're right, would be extraordinarily large. Now, the probability is that you're going to lose everything, but it's a tremendous risk reward if you believe in that. So I have to listen. So to go back to your question, those around me, I try to listen to. And I have the real honor of sort of being on the board of the Robinhood Foundation here in New York, which is one of the largest not-for-profits. And we have this investors conference. And there's always some really brilliant people speaking at it. And if I have the opportunity, I try to listen and learn from all of them because it's insightful. And the biggest lesson I've learned is that I don't really know that much. I can do all this work, but the market is right and I am wrong. And that took a long time to learn because human nature is I want to be right. And that's why you hold on to losing positions because you want to prove that you're right and the market's wrong. But the reality is nobody cares. The market is the market and it doesn't care whether you're right or wrong. And it will, and sometimes, and I say this to smaller traders all the time, is that you've got a bad position on, you know it's bad, and you're going to continue to lose money until you get out. So you're going to put the low in the marketplace. You can put it in today and have a small loss and put in the bottom, or you can wait and sell it and have a larger loss and put in the bottom. Because when they have you, and you have to be aware of that. That is the most humbling lesson that I've learned over all the years is that when you're wrong, get out and then think about it afterwards.
Peter, I want all the traders, all the investors, everybody who's up in their accounts, down in their accounts to listen to your words and your general attitude and demeanor, because that is what a trader sounds like. A successful one, someone who's humble and honest, because this market kicks us the wrong way so many times over the years. We're going to leave it there. Lots of wisdom, I'm going to use that word again, in those words. Always a pleasure to have you joining us. Peter Borish, on behalf of Yahoo Finance Uncut, and all the viewers here, thank you for joining. We're going to send you off until the next episode.
Thank you so much. It's really an honor.